Hello and welcome. So in this lecture video, will involve going over some quick check problems, okay? Just to check your understanding of the accounting equation and debits and credits and how to calculate account balances, okay? So before I did that, I wanted to return back to this problem just to make sure you understand how I calculated the balance in cash here. So if you look back at this problem, remember this was our example 5. Fast Forward provides consulting services and immediately collects $4,200 cash. We said that assets go up because cash is going up. Equity goes up because revenues are going up. And how do I know that revenues are going up? Because it says provides consulting services. How do I know cash is going up? Collects cash. It says cash is going up. Liabilities are not affected. So then we debit cash, credit consulting revenue. I have my T account here for consulting revenue. That's on the credit side. And then I have my T account here for cash. Remember, I had that $30,000 investment. Then I had the $4,200 collection of cash. We paid $2,500 for supplies, credit cash for $2,500, and we paid $26,000 for equipment, the credit to cash for $26,000. So then what I can do is I can draw a line right here, and then I can put in the balance in cash. This is how much cash we have left over, and you can see it's a debit balance. How did I get that? I took the $30,000 plus the $4,200, added up all my debits, and subtracted all my credits, and I get $5,700. Remember, the normal balance for an asset account such as cash should be a debit. All right? So now what I want you to do is I want you to pause the lecture video, and I want you to do number 73 right there, and I want you to do number 74 and 82 on the next page, and then we'll review it, and we'll do 88 together, okay? So go ahead and pause the video. Hello and welcome back. So let's look at the first one. Which of the following statements is incorrect? The normal balance for accounts receivable is a debit. That's true. That is correct. Why is that correct? Because accounts receivable is an asset, and the normal balance for an asset is a debit. The normal balance for owner's withdrawals is a debit. That is also correct. Why? Remember, the way to increase owner's withdrawals is with the debit. Why do I increase or recognize that the owner was withdrawing money from his or her own business with a debit? Why do I recognize owner's withdrawals with a debit? Because owner's withdrawals decrease equity, and the way to decrease equity is with the debit. So B is also true. The normal balance of unearned revenues is a credit. Well, we talked about unearned revenues in the first lecture video for this chapter, and we said that unearned revenues are liabilities. That's the situation where you got paid up front and you owe future services. So that's a liability. And yes, the normal balance for a liability is a credit. Let's look at E. The normal balance for owner's capital is a credit. That is also true. Owner's capital, owner investment, owner's investing money in the business. Remember with the example 1 that we did in the prior lecture video where the owner invested $30,000 in his business. We debited cash and we credited owner's capital. So yes, the balance of owner's capital, the normal balance should be a credit. The one that's wrong is D. The normal balance of an expense is a credit. No, the normal balance of an expense is a debit. Why? So if I were to pay rent expense, what would be the journal entry? Debit rent expense, credit cash. Why do I recognize expenses with the debit, which would mean the normal balance of expenses is a debit, not a credit? Why do I recognize expenses with the debit? Increase in expenses decreases equity. How do I decrease equity with a debit? That's why. Okay? So let's look at number 74. A credit is used to record an increase in expense. No, that's debit. A decrease in unearned revenue. No. Unearned revenue is a liability, so a credit would record an increase in unearned revenue. A decrease in revenue, the way I recognize an increase in revenue is with a credit. A decrease in capital account, no, the way I recognize a decrease in owner's capital or owner investment is with a debit. Okay, so the right answer is B, a credit is used to record a decrease in assets. So remember when we had some of those examples where we paid for supplies with cash, we bought $2,500 with cash. What was the journal entry? Debit supplies, credit to cash. Cash is going down. Cash is an asset. The way I decrease an asset is with a credit. Let's look at the next one, number 82. Rocky Industries received its telephone bill in the amount of $300 and then immediately paid it. The journal entry would be a debit to telephone expense, and I'll write it out, debit to telephone expense for $300, and then a credit to cash for $300. That would be my journal entry. And so sometimes writing out the journal entry helps you to answer this question. So I'd actually encourage you to do that when you're given a test, a problem like this on the test, because this would be a fair test question, is to write out the journal entry and then use that to then figure out which one's right. Well, you can see a debit to telephone expense. Why? Because this is it's telephone expense, utilities expense. You could also say utilities expense. Be fine. Here we'll just say telephone. Telephone expense, $300, credit to cash. Expenses are going up, so I'm recognizing that my expenses are going up. How do I recognize expenses going up? With a debit, and it says I immediately paid it. What do I pay things with? Cash. Cash is going down. Cash is an asset. How do I decrease an asset in terms of debits and credits? With a credit to cash. If it said credit to accounts payable, what that would say, received its telephone bill and decided to pay it later. That would be debit telephone expense, credit accounts payable. Debit to cash means cash is going up, so that doesn't make sense. Credit to telephone expense would mean the expense is going down. That's not true. Debit to accounts payable, that means we paid off the accounts payable, and that's not what's happening either. Okay? Let's look at number 88. On September 30th, the cash account of Value Company had a normal balance of $5,000. During September, I'm going to write out cash. Okay. So on September 30th, it had $5,000. So I'm going to draw a line to say that is my ending balance. That's on 9/30. That's my ending balance, right? And it says a normal balance. What's the normal balance for an asset account, such as cash? Debit. That's why I put it on the left side of the T account here, showing it's a debit. During September, the account was debited for $12,200. Well, we know that goes on the left side of the T account. Okay? And credited for $11,500. Right? That goes on the right side of the T account. What was the balance in cash at the beginning of the month? Well, that is my unknown. That's my question mark on 9/1. I have question mark there. So what I need to do is to set up a little algebra equation, simple algebra equation, to help me solve this problem. So what you can say, and instead of the question mark, I'll just write beginning balance. That'll be my unknown, beginning balance. Okay? So I'll come over here and I'll say beginning balance plus how much cash I collected, my debit. This is how much cash I collected, minus how much cash I spent, equals how much I have left over. How could you think about this in terms of you, right? Well, let's say, you know what? You spent $100 because you took out $100 from the ATM, right? So you have you have a receipt. We'll say you have an ATM receipt for $100, and then you know that you spent another $50, right? And then you look down in your wallet, and then you have $25 left over. Can you tell me how much you started with? Yeah, you can figure that out. You can figure that out, right? You can back in to figure that out. You can say, start or yesterday, right? Start plus how much you withdrew from your ATM minus how much you spent equals how much you have left over, which is how much money you have in your wallet now. Okay. So now what we can do is just solve for beginning balance. And when you solve for that in terms of algebra, right? You isolate the beginning balance in terms of algebra, and what it's going to be is $4,300, and it's going to be $4,300 debit because it's on the debit side. Okay, not credit, that would mean spent. This is debit balance, which is the beginning. Okay, all right. So let's look at number 90, and I'm going to review number 90 really quickly, but I want you to solve the problem. But let me just kind of review it before you do. This is just like number 88. It's very similar. Okay? But I'm using two different words. Cash receipts, cash disbursements. Cash receipts means cash coming into the company, so debits. Cash disbursements means you're spending money, so a credit to cash. Okay? So I just wanted to clarify that before you solve that problem. And then look at number 92. You need to think about the business entity assumption when solving this problem. I want you to think about the business entity assumption when solving this problem, okay? So I want you to pause the lecture video and do those two, but keep those two hints in mind when you're solving it, okay? Okay, so in terms of solving this problem, number 90, what you want to do is set up a T account and then use that T account to help you develop the algebra equation to solve the problem. So we want to know what beginning cash is. We know at the end right over here, right, because this is January 31st is conceptually like the beginning of February. So we want to know what beginning balance is. We know ending balance is 1,800, and that's on the debit side because it's a normal balance. And then 7,500 I told you was the debits. That's the cash receipts. $8,600 was the cash disbursements, the credits. And so then we have our unknown beginning balance. We set up our algebra equation. Your beginning balance plus 7,500 minus 8,600 equals 1,800. Solve for beginning balance, and what you get, beginning balance is C, $2,900. Okay. Let's look at number 92. It says, if Jones, the owner of Jones Hardware, uses the cash of the business to purchase the family car, the business should record this as D, Tim Jones withdrawals. And I said when you answer this question, think about the business entity assumption. Remember, the business entity assumption says, this is back from chapter 1 lecture videos, it says that you have to account for the records of the owner separately from the records of the business. So if Tim Jones is purchasing a family car, he has to withdraw money out of the business checking account and put it into the personal checking account. So this is really owner withdrawals. So the journal entry to recognize an owner withdrawal is debit withdrawals and credit cash. How does this keep the accounting equation in balance? Well, cash is an asset and it's going down, right? So assets are going down. Liabilities are not being affected at all, but equity is going down. Why is equity going down? Because owner withdrawals is increasing. As owner withdrawals increases, equity goes down. And so therefore, how do I recognize an owner withdrawal? We talked about that before. We recognize owner withdrawals with debits. Why do we recognize owner's withdrawals with the debit? Because as owner's withdrawal goes up, equity goes down. The way to recognize that equity is going down is with a debit. Okay? So you can't debit cash. Well, I mean, debit cash would mean cash is going up, so that doesn't make any sense. This is not Tim Jones' salary. He has to withdraw the money to buy the family car. And it's not salary expense, credit to cash. It's not that because he has to withdraw the money to buy the family car. This would mean that he bought it for the business, which is not the case. Family car. Okay? All right, so I'm going to end this lecture video now. Thanks so much.